Kick off with a DraftKings. Their symbol is DKNG. The short on the float is a 7.5%, about 89% institutional owned. I'm surprised a little bit here. I thought they did have a PE ratio with earnings, but it says no PE ratio. So they have, at this point in time, no earnings. The industry does have a PE at 34. Price to sales, 1.8. That is better than the industry at 1.9. Price to book value, very expensive, 17.4 versus 3.9. And price to cash flow, also expensive at 16.7 versus 9.7. Now, the PEG ratio is very good. It's only 0.3 versus 3.5. So it shows you're paying a very low price for the future growth of this company. Unfortunately, earnings of last year, nothing there. The industry shows it was down 3.8%. Sales for DraftKings did increase over last year by 27%. That was above the industry, which actually declined 17%. And wow, this one I'm going to argue with, but I'll give the number now. The 5-year earnings per share growth estimate from the analyst is 67.2%, well above the industry at 12.8%. They do not pay a dividend. Their balance sheet looks pretty, well, their current ratio looks okay, 1 versus 1.4, but the debt to equity is high. It's 3. That is above the industry at 2.8, so a high debt industry, but I still don't like a lot of debt there. Intangible assets, about 55%. That's pretty high. Net profit margin is only 0.1%. That's not very good. Return on equity is negative 0.6%. Cash flow is okay, $508 million. Industry is about $612 million. What do you got earnings going forward?
Yeah, I was just looking at the company too. I mean, obviously, I kind of know them for their sports betting.
Yeah.
It says and I did see that they were going to kind of get into prediction markets as well to kind of compete in that realm. I don't know where that kind of stands in the process, but they also have iGaming or online casino products, which includes blackjack, roulette, baccarat, and slot machines. So I didn't know that they were also in, I guess, just the gambling. I knew they did the sports gambling, but the gambling, they do that too. Now, this is where things get interesting for DraftKings. The ticker symbol, again, DKNG, $22.31. 52-week range, low here, $21.01, and the high, $49.59. Year to date, the stock is down 35%. Over the last year, down about 55%. Last 5 years, it's down 63%. It looks like their high, was over $70 a share. Now, going forward for this business, we go out to December 2027. I see estimated earnings per share of $1.11. It gives us a target sell price of $18.43, so it still trades at expensive multiple. We'll call it about 20 times those future earnings. But this is to your point about the earnings growth. I have no clue how this is possible, but they didn't have earnings last year. They're looking for earnings now of 40 cents in 26, which would be growth of 3,900%. Then growth in 2027, 176%. Now, there's less analysts in 2028, but they're looking for 68% earnings growth. I mean, I don't know where all this expected earnings growth is coming from. But if I was a growth investor and this was actually accurate, I mean, that's a pretty good PEG ratio in terms of what you're paying for the earnings growth of that business.
Yeah, and the thing I look at, too, you brought up the prediction markets. And again, you got two main players there, Kelsey, I think it is, and Poly Markets, the two that do it. Now, from my understanding, like Robinhood, the brokerage firm, they go through Kelsey to get the prediction markets. You can go directly to Kelsey. And I
Kalshi, yeah.
Well, how do you pronounce it?
I think it's Kalshi.
Kalshi, it's what, Kalsi or something. Yeah. I think there's an H in there somewhere, but
SHI.
SHI. But the thing is, you can go to them directly. Why would you go to DraftKings or why would you go to Robinhood and pay an extra premium for that when you get it directly? And again, I did test it out myself. So I was like, what is it all about? I was shocked to learn that you can use a credit card when you go to these prediction markets. I mean,
it's terrifying.
It's terrifying because you can't do that when you do investing. I don't think you can do it at DraftKings. I hope not. But that's a problem that's happening. We talked before about the CFTC, the Chicago Futures Trading Commission.
Is it Commodities Futures Trading Commission, not Chicago?
Could be. Yeah, could be. Yeah. So I think it's Chicago. I think it is Chicago. I think they cover it. Well, you look it up when I'm talking about it.
Commodity Futures Trading Commission.
Yep. But what I look at there is they got rid of like 12 attorneys. I mean, it's like the Wild West with this stuff, and people are going to get burned. And it was so easy to do. I did a trade. I've been on the Seattle Seahawks. I won $100 or something. Oh, great. but then I lost it predicting unemployment.
Inflation, yeah.
Inflation, that's what it was.
Was it going to come in above or below 2.4%? And it came in at 2.4%.
So I lost all the money that I won from the Super Bowl.
It's kind of like the roulette. That's how they get you, right? It's like, oh, you have a 50-50 shot because black or red.
Yeah.
But, oh, no, there's the green that throws in the odds and
Yeah.
totally screws you over.
And I did it because I wanted to see what it was like. It is way too easy to do.
Oh, yeah. And I've never thought about that point. Why do you go to Robinhood, these other players, when Kalshi is the direct market? I don't know how it works.
And it was so easy. It's just an app. I was done in about 5 minutes. All right, so stay tuned. When we come back, we'll talk about Mattel, Ferrari, restaurant brands, and our financial planner, Harrison. He's coming up, so stay with us. Listen to Brent and Chase on the Smart Investing Show. We'll be right back.